Assalamu alaikum friends. Welcome to day 11 of AFM revision crash course. Today's topic is interest rate risk. Yesterday we covered in day 11 foreign exchange risk. So a lot of the hedging techniques are similar here, but there are a few differences because this is for interest rate risk, right? So if you understood the exchange rate risk properly, you will understand interest rate risk also, especially when it comes to options and future. So let us go to the topics that we are going to cover today. We are going to go through the past exam. Then we are going to define what is interest rate risk. Then the hedging techniques, for example, forward trade agreement, right? In exchange rate risk management, we have forward. We choose a rate, bid or ask one rate, and then we convert. Here, there's a little difference. We'll see a little bit later. Interest rate future we have. Interest rate future also the calculation of closing future price and all is required. It's almost similar to exchange rate risk future, but there are a few differences. For example, when you calculate number of contracts, interest rate option also is similar like interest rate future. The difference comes in the number of contract when you calculate, and then interest rate swap. So let us go to the past exam. As you can see, that mostly this question comes in question number 2. Okay, both exchange rate risk and interest rate risk mostly they come in question number 2 as a 25 marks question. It can come as question number 2 or question number 3. Okay, but as you can see here from the past exam it's mostly 2. It does not matter whether question number 2 or 3. What matters is it comes as a 25 marks question, because mostly the good thing about this and the exchange rate risk management is that the questions are very standard. Like they don't change the questions very often. It's very similar type of questions. Every time they will give you the forward, future, options or swap. Then you will be asked to calculate and find out which hedging technique is the best, recommend which is best. So mostly this is the type of question that they ask. Sometimes they will ask as a part B a theory question, okay, based on risk management. So as you can see, forward rate agreement, interest rate future, interest rate options, discussion on interest rate hedging methods. Okay, you need to discuss as well. That means you have to know the advantages as well as disadvantages of all the hedging techniques. Interest rate swap came once and collar came twice. Now let us go to the interest rate risk. What is interest rate risk? Interest risk, interest rate risk means the risk, okay, that you are incurring due to changes in the interest rate. Interest rate also can go up or down. For example, you have taken a borrowing on a loan at 5% when the interest rate was 5%. Now after 3 months interest rate went to 8%. So it's a loss for you, 3% loss for you. So here we are studying in this video this topic, how to hedge those interest rate risk, whether for borrowing or whether for a deposit or an investment. It's the same way, right? For investment we need a higher interest rate, and for borrowing we want a lower interest rate. So if there's a unfavorable movement, it's a loss. Now hedging techniques, as you know, forward rate agreement, interest rate future, interest rate options, interest rate swap, right? In interest rate options we have floor, caps and collar. You need to know these three terms: how floor operates, how cap operates, and how collar operates. And then we have interest rate swap. And another thing, guys, don't at all think that collars or swap or floor or future, these are tough, complicated things. And no, because I get a lot of doubt, people having doubt on collar and swap path, especially this two area. So it's not at all tough. Okay. In fact, this too, when you understand it, it will be very easy. The thing is, because it has a very limited, they cannot vary. What do I say? They cannot change the question. They can only ask you similar type of question. So if you see the past paper question for collars and interest rate swap, they can only ask you that type of question only. The variety in this type of question is not so much. Unlike your investment appraisal, adjusted present value, or option pricing model, they can change the question. But here, you just need to know how to calculate collars and interest rate swap, because there's a fixed method. Standard method is there. You know it, and that's it. So let us go to the forward rate agreement first. Forward rate agreement means, okay, you're using a rate. A rate is fixed at which you are going to pay or receive interest. Okay, let's say your forward rate agreement is 5%. Now, for forward rate agreement, you need to understand two scenarios. What happens when your variable rate or the interest rate is above this forward rate agreement or below this forward rate agreement? What happens? You need to know that. First, if interest rate, sorry, if the FRA rate is higher than the variable rate, okay, the variable rate is known as LIBOR. For borrowing, let's assume for borrowing. I didn't write for the receivable part, you can take the opposite of it. You can understand, right? You can implicate. So FRA rate is higher than borrowing, higher than variable rate for borrowing. You pay the difference to the bank. What you need to understand is you are the one who is paying the difference to the bank. Because see, by the contract you are fixed, whether high or whether low, whatever it is, FRA rate only you have to pay. You have to pay up to the FRA rate. So if anything, whichever is higher, FRA or the variable rate, LIBOR, the higher one only you have to pay. Because FRA rate is higher, no? FRA rate only, higher or lower. So since your variable rate is lower and FRA rate is higher, the difference you will be paying to the bank. Because when you are taking a borrowing, you are paying interest at a lower rate, right? At LIBOR. So that extra you have to pay to the bank because you have to pay at FRA rate. For example, FRA is 5%. Your LIBOR is 3%. So normally you pay 3% of interest on the loan. Now you have to pay extra 2% also because your FR is 5%. So in short, whatever you are receiving or paying, you have to make it up to 5% only. It cannot go above 5%, it cannot go low, it cannot go below 5%. So if you are paying anything less than 5%, you have to make that extra 2% to make it up to 5%, which is your FRA rate. FRA rate will be given to you in the exam. Okay, and when you see the way they present the FRA rate, another thing is students get confused which one to take. Like in currency risk, we have two rate, ask rate and the bid rate for forward. We have to choose there. In the interest rate, it's not like that. Interest rate, they will give you like FRA for 3 month to 4 month or 4 month to 9 month, like that they will give you. So you have to know at which date you are starting and for how many months you need it. Okay. So they will give you that rate like that. You have to choose from there, depending on the scenario, for how many months you have to hedge and you are starting on which day. Let's say they tell you that in 3 months, okay, you'll be hedging for, you need to hedge for 4 months, starting in 3 months time. So it will be 3v 3 plus 4 7, so 3v7. That's how you choose FRA rate. Now coming to the second scenario where it is lower, that means you are paying at a lower amount. Your FRA rate is lower. So if you are paying, so that means here let's say FRA rate is 3%, LIBOR is 5%. Okay, both will be given to you in the exam, the LIBOR as well as FRA rate. You just have to know whether you have to pay the difference to the bank or the bank has to pay the difference to you. That only you need to understand. So FRA rate is lower, so you are paying at 3%. Now, but your variable rate is 5%. So what should you do? That difference you will receive from the bank. Because you are lower, no? Sorry, I'm sorry. You have to pay the variable rate only. FRA rate is basically taken to find out the difference, whether you will be paying or the bank will pay to you. So you will be paying at 5%, which is your LIBOR. But FRA rate is 2%. That means you are paying extra 2% more. So that 2% you will receive it from the bank. So that again 5 minus 2, your LIBOR again becomes 3%. Understanding? Now, for further reading, you can read on your ACCA website their technical article named as FRA and interest rate swap. Their FRA is covered in more detail, and I really recommend you to read it. Right? It's a must read. Now let us go to interest rate future. The interest rate future, here also like currency rate future, we have deposits and we have borrowing, right? So we should know when we have to sell the future, when we have to buy the future. Here also we have to do the same thing, buy future, sell future. but the rule is fixed. When it's a deposit, you buy future. When it's a borrowing, you sell future. Okay, so for deposit, buy future. For borrowing, sell future. You need to remember this, right? Now, for IRF means interest rate future. The minimum price movement is usually 1 basis point. You need to understand this. In interest rate future, we have this, not in currency rate. Sorry, currency risk. And tick value. You need to calculate a tick value. What's tick value? Sometimes tick value will be given to you. Sometimes you need to find out. Most of the time, you only have to find out. Okay, unit of trading into 1 basis point into fraction of year. Fraction of year means for how many months you are hedging divided by 12. Fraction of year. Okay. Now, definitely the stick value and all those things you will understand through a question. So you don't have to memorize these things as it is. Like tick value is equal to this. And how the prices are quoted in IRF, interest rate future. You need to understand. Because you can present interest rate future calculations in 2 ways. Either in terms of price, either in terms of interest rate. Whatever you find it easier, you can do it, right? So the prices are, let's say your interest rate is 3%. So your price will be 100 minus 3, which is 97. 97 is your price. You see? So 100 minus that price, that market rate, is known as the price of interest rate future. Or sometimes what happens, they give you the price. They say 97 is the price of interest rate future. That means interest rate is 3%. Okay, because 100 minus 97. Sometimes they give you the price, you have to find the interest rate. Sometimes they give you the interest rate, you have to find the price. Now, future, same way. How we have for the currency risk also. We need to find the basis to find the closing future price. Okay. So because there's a basis risk is there, that means future hedges are imperfect. Because we have some basis risk that is remaining at the end. If future hedge was perfect, we would not have any basis risk. It would be 0. But since we have, that means future hedges are imperfect. And another scenario where future hedges are imperfect is due to rounding of the number of contracts. Remember yesterday I told you you have to round up the number of contracts for currency risk management. Same you have to do here also. You have to round up. The only difference is when you calculate the number of contract, you have to include a fraction here in the interest rate future, which was not there in your currency rate future, currency risk future. Okay, you have to round to a whole number. For example, if you're getting 37.2, number of contracts will be 37. So that 0.2, that difference is there, right? You are taking a lesser contract. So you cannot entirely or completely hedge using future. That's why it's imperfect. This, they might ask you to write as a theory, but sometimes they ask you this question, why future hedges is imperfect or why it's not a good way of hedging. So then you can talk about one is basis risk, the other one is rounding of number of contracts. These two reasons you can give. Now let us go to formula to calculate number of contracts. This is the formula, fixed formula, and you need to know it. Another question which students often ask me, that since this is on a CB platform, do we have to write the formula? The answer is no, you don't have to write the formula. Because anyway, when you're calculating in the Excel, when someone clicks on that cell, they will be able to see the formula. You're actually using the formula. Okay, so you don't have to write the formula as it is. Number of contract is equals to loan or deposit divided by no. You don't have to write it. Because it's time consuming also, okay? So on CB platform, things are much easier now. You don't have to do many of the things which we had to do when we were giving exams on paper based. So number of contracts, whether it's loan, whether it's deposit, okay, the amount will be given divided by contract size. Contract size also will be given to you. Into, so that into part was not there in our currency risk management. But here we have for interest rate future. That fraction is known as, the fraction is the second thing, which is loan or deposit in months divided by 3 months. This is the fraction. That means the borrowing is for how many months? It could be for 5 months you want to hedge, or 3 months, whatever it is. That divide by 3 months. Why? It's not divide by 12, divide by 3 months. Because that is the contract duration. Contract duration means your future. And future is for 3 months only. Okay, so it is always divided by Whatever the months you have to hedge, divide by 3. So that's your fraction. Okay. Next, let us go to an example to understand interest rate feature better. A question where I have solved it. So we are hedging here for a fall in interest rate. That means for a deposit, for an investment, not for a borrowing. Okay, so this is the question. It is now March. This is how your exam questions will be. The exact nature. It is now March. They will give you what is the date today now. In the UK, they have recognized a short-term cash budget and it's likely to have a surplus of 10 million pounds. It's a surplus, okay, arising in 2 months' time for a period of 3 months. I've told you, FRA rate, they will give you like this only. But they didn't give you the FRA rate here because the main thing is we are using future here to show how futures are worked out. For a period of 3 months, so we are hedging for 3 months, which it plans to invest in a short-term money market instruments. Okay. It is concerned that interest rates in the next 2 months may fall and wishes to hedge this risk using future contract. Now, what are we doing? We need the information. Contract size. What is the interest rate currently? What is it priced at? So, June 3 month sterling interest rate future. They will give you the future. Interest rate future and for which month. Okay. Interest rate future contracts are available with a contract size of 500,000. So, contract size is given as 500,000. And how much you have to hedge? 10 million. They are currently priced at 96. That means interest rate is 4%. So you see 100 minus 4 is 96. So 100 minus 4 is 96. And 100 minus 96 is 4. So either way you will get the interest or the price. Sometimes they might not give you the interest rate. They might just tell you it's priced at 96. That means interest rate is 4%. So you are required to illustrate how you are going to hedge this movement in interest rate. If the interest rate falls to 3%. That means future price will now move up to 97. You see, interest rate falls down, meaning your future price will increase. So now the solution is, okay, this is the scenario. This is not the actual answer now. Okay, we didn't go to the steps of calculating. The actual interest on 10 million for 3 months will be how much? Just take 3 over 3 divided by 12 into 10, which is 75,000. That's the actual interest. You should always keep the actual interest ready with you first. And then at 4% because interest rate went, that is actual interest rate at 4%. Okay, that 3% it went down. The interest rate that went down to 3%. So 3%. And you have to calculate the original amount also 4% to see what is the loss. So at 4%, that means 4% of 10 million into 3 months. Still you have to take into 3 months, okay? Which will be 100,000. So you see, when interest rate fell down, your interest also fell down to 75,000. And this is a deposit. This is an investment, not a borrowing. So it's not a good thing. That means you are now receiving less interest after interest rate fell down from 100 to 75. So it's a loss in the spot market, right? So the loss is how much? The difference 100 minus 75, 25,000. It's a loss. How does future operate? Future says that if there's a loss in the spot market, you'll be having a profit in the future market. So now you see, if you're getting a loss in the future market means you're wrong somewhere. This is a hint for you. This is how you need to know. Same for the currency risk also. If one is making a profit, the other one has to make a loss. So now let's start with step 1. Step 1, you're going to set up the position. Okay, here the company wants to hedge against a fall in interest rate. So you first need to find out the number of contracts, and this is a March contract, okay, for March, because now it's March. So you are first finding today at March what is the number of contract. So the amount that you want to hedge is 10 million and the contract size is 500. Both are, and here another thing, there is nothing to convert or anything like that, okay, because here the currencies will be same only. This is not currency rate future, so don't get confused with that one. Here the contract size also will be in the same currency. The amount that you want to hedge also will be in the same currency, because this is not about currency. That's about interest. So that's a good thing. No conversion and nothing and all, and thinking about currencies and all. Everything will be in same currency. So 10 million divided by 520 contracts. Okay, you got the whole number. That means there will be no this thing. It is perfectly hedged at 96 because your interest rate is 4%, right? Current price. Then step 2, you need to close out this. Okay, the future position. That means you have to sell at 97. Okay, before that, first of all, you tell me you are going to buy or sell future. This is an investment. You are going to buy future. You see, you buy future. Buy future means how are you going to close the position? By selling the future. So you buy at 96 and you sell at 97 when interest rate fell down to 3%. So now you have to calculate a profit or loss on the future. So you buy at 96, you sell at 97, and it's a profit of 1. You see? But that's for per contract. You have to find the total gain. So the total profit will be, this is the way you calculate. Number of contract into 12.5 into 100 ticks. 20 contracts into 12.5. What is this 12.5? Usually this will be given to you in the question, okay? But this is in the textbook. It's given as, because this is what contract? This is a sterling interest rate future contract. Sterling contract. Right? Sterling futures are, the tick value is 12.5. Okay? So because most of you will be thinking how 12.5 came here. But you don't have to memorize or anything like that. In the exam only they will give you the tick value. So don't worry about it. 12.5 into 100 ticks. Or you can say, because the gain is 1 basis point, so it will be 100 ticks. Okay? Because you have to multiply with the ticks, number of ticks, to find the total profit. So that one gain that you are getting, gain per contract is 1. That means in terms of ticks it will be 100. Okay? Because 1 basis means 100 ticks. So 20 into 12.5 into 100, which is 25,000. Now, did you see the loss? Just go up and see in the solution. What was the loss in the spot rate? 25,000. And what was the profit in the future? 25,000. It will be exactly the same in this case. Not in most of the case. Why? Because you have used the exact number of contract, 20 contracts. There was nothing, no error or due to rounding up or down. Exactly 20 contracts. So in this situation, your profit and loss will be same. Okay. Now, here also you need to find out the closing future price, which is known as lock-in rate or closing future price. Okay. Remember, in the exam, whether it is interest rate risk or currency rate risk, you will not be told what is the closing future price. In fact, you have to find it out. Because without that, you cannot find out the profit or loss on the future. Okay, so you have to find out. And the way you find out is very similar to the exchange rate risk. So the aim of this interest rate future is what? To fix an interest rate. Okay, this is how you find out. 100 minus current future price plus unexpired basis. So you have to find out the unexpired basis. Okay, you have to add it with the current future price. Current future price means the opening future price they will usually give you in front of that future only. That March future is this much, June future is this much. At 97 or 94, they will give you that. So with that, you have to add the basis risk, which you will be calculating. But that you have to minus it from 100. 100 minus that in order to get the rate, interest rate. Okay. But in the currency rate, when we calculated the closing future price, nothing to minus with 100 from. Okay. We just took current future price plus unexpired basis. There also is the same thing. Here also is the same thing, but we minus it from 100. Here, both exchange traded future and interest rate future needs calculation of closing future price. Yes, under both. That's a very key topic. Okay, that's why I've included it as a separate point. Interest rate option. Now let us go to interest rate option. So interest rate option means an option to buy or sell future. It's an option on the interest rate future. Okay. So that's why if you see the contract size is same. The contract size of future as well as the contract size of option almost it's always same. Okay, everything else remains same. The only difference is whether buy or put, sorry, put or call, and you have to find premium. That's the difference with future. Rest all is everything same. Finding number of contracts, finding a profit or a loss. Okay. So usually this will be exercised when there's an adverse movement, right? When it's a favorable movement, why would you exercise? You can just let it lapse and still get the benefit. So because that flexibility is there in interest rate option. Option means whether interest rate or whether currency rate. It has that flexibility to take advantage of benefit also. That's why this is more expensive than your forwarded agreement. Okay. Next. You need to know what is interest rate cap, what is interest rate floor, what is interest rate collar. So interest rate cap means what? Cap means ceiling. Okay. That is like the maximum interest rate that a borrower can pay. You're putting an amount to that, the ceiling. That beyond this level, your interest rate will not move up. You don't have to pay. There's a limit is set. That this is the maximum that you have to pay. This is for the borrower's position I'm talking about. Okay. But it's an option. Okay. Interest rate cap is an option only you're taking. But in option, what do you have? You can take the advantage if the interest rate moves in your favor. And if interest rate is not moving in your favor, you exercise the option and hedge your position. But interest rate cap means it is not an option. You cannot take the advantage if your interest rate goes below a certain level. Like it only hedges your position up to a certain amount. It just sets a maximum interest rate. If your interest rate goes below, downwards, for borrower I'm talking about, you cannot take that advantage. So it's just one way. You can say this option is one way option. Why the opposite is true for floor? Floor means you are setting a minimum level. That means your interest rate will not follow below this level. This is for the lenders, the one who deposits. And interest rate collar. Interest rate collar, if you see, the cost is lower compared to an interest rate cap or a floor. Okay. How? Like a cap, similar to cap, collar is also used to fix a maximum interest rate. Okay. They also fix a maximum interest rate for the borrower, and same for like floor, they set a minimum level also. So there's a maximum level, there's a minimum level. They set both the level. That means you can only take the advantage in between only. That means unlike a cap, the collar holder is unable to benefit from the reduction in the rate of interest below a certain level. If your interest rate goes below a certain level, under collar you cannot take that advantage because there is a level to your floor also. But in cap, it's not like that. No matter however much interest rate goes down, you can take the advantage in the cap. It only hedges your interest rate up to a maximum level. That means beyond this, if your interest rate goes up, you don't have to pay that. You are hedged. But below that, if it goes, I'm talking about cap, you can take the advantage because there's no level. Down level is not set. The minimum level is not set. Only maximum level. But in the collar, both the side they are fixing, upside and the top side. Sorry, top side and the bottom side. I'm sorry, I'm talking the same thing in two different words. And for floor also is the same thing. Okay. So similarly, a collar can be used like a floor to set a minimum interest. Here also they set a minimum interest, but here they cannot take the advantage of a maximum yield. Yes. If it goes above your ceiling level, your cap level, in the collar I'm talking about, you cannot take that advantage when you're taking a collar. So collar limits both upside and downside. Okay. Upside for floor, downside for cap. That's why this collar is less costly compared to an option or compared to a cap or a flow. Because in cap, what do you do? Just let me go back again. Interest rate cap. Okay. Premium. You have to pay a higher amount of premium. Same for floor also. But when it comes to collar, the premium is less. Because you are buying, let's say this is a borrowing. You are buying put and you are selling a call. So you are receiving a premium and you are selling a premium. So the premium are netted off against each other, the payment and the receipt. That's why your premium reduces. You understanding? But for interest rate cap, you are buying a put option. You are buying a put option means receiving premium. Sorry, you are buying a put option, right? You have to pay premium. Interest rate floor also you have to pay a premium. But caller you are paying and you are receiving premium because you are buying a put and you are selling a call for borrowing in the caller. Now let us go to an example. So a caller might have a cap of 8% and floor of 6.5%. Don't tell me floor has to be 9%, okay? Floor, obviously floor will be below cap only, right? Your floor cannot be above your ceiling. So cap is like a ceiling only. So 8% and 6.5%. So when you're fixing the rate for borrowing, okay? Maximum is 8%, minimum is 6.5%. Okay? So what is the cost for the caller? It is simply the difference between the premium that is payable on the cap and the premium that is receivable from selling the flow. This is we are talking about borrowing. So in borrowing, what do? We buy a put and we sell a call. Buy a put means buy a premium and sell a floor. So we pay and we receive premium. They are netted off against each other, premium is reduced. Hence the cost of the call is reduced. This you can write as a theory part also if they ask why call is a suitable hedging method compared to a flow or a cap or an option. There's a recent article on this which you can read on your ACCF website. How to answer an interest rate risk management question which covers FRA future and option. It covers everything, so go and read this article. Interest rate swap. Now this is very interesting. I have a whole video on interest rate swap, and the good thing is you don't have to watch all my videos. If you just watch any one of my video where I've covered a full question on interest rate swap, that's more than enough. Provided that you understood it very well. Because every question is same and every answer, the way you answer interest rate swap is same. It does not change from one question to another question. Okay, interest rate swap means you are swapping fixed for variable or variable for fixed with a counterparty. So they can be used to do two things. One, you want to hedge against movement in interest rates. Second, to obtain cheaper finance. To obtain cheaper finance. For example, you are taking a loan, a borrowing, let's say, but your variable rate is too high. So what do? You swap with a fixed rate in order to reduce the cost of borrowing, hence to obtain a cheaper finance. So out of these two reasons, a person can use interest rate swap. And most of the time in the exam also, uh, more than currency rate swap, it is the interest rate swap which comes. Okay, so you need to focus more on interest rate swap compared to the currency rate swap. Now let us go to this. So it is the bank that normally arranges the swap. Okay, and they quote the ask rate. That means you have to give a rate to the bank. So you are giving a fixed interest cash flow to the bank and you are receiving a variable return or LIBOR from the bank. Okay, usually the bank's profit is usually 2 basis point. Okay, but usually they will tell you this is just a range that they are giving. Normally in real life, in practical life, that's how they make profit. The bank, the basis point is usually 2 basis point, but you don't have to remember this because in the exam they will tell you what is the bank willing to pay and how much you have to pay to the bank. For further reading, you can read a technical article on ACC on FRA and interest rate swap, which covers swap in more detail. So you see that for interest rate risk management, there are so many technical articles on your ACCA website. Go there and read it. So that's it for interest rate risk management. We have covered successfully. Now tomorrow I'll be covering accusation and merger. So we are moving towards acquisition and merger. 2 more videos are there, day 12 and day 13, where I'll be covering acquisition and merger. Day 14 will be on reconstructions and reorganization. That will be the final video. So strategic aspect of acquisition is more like your theory answers, which will help you to write your theory answers. Day 13 will be about calculations and all, where we'll be doing business valuations and all, using PE ratio, using free cash flow, right? So see you tomorrow. Until then, take care.